Welcome to the deep dive. Here's a riddle for you. How does a major global company, LKQ Corporation, announce its quarterly results? Revenues largely meeting Wall Street expectations, yet see its stock plunge by as much as 15%.
Yeah,
It sounds completely counterintuitive, doesn't it?
it absolutely does. I mean, that kind of market reaction, especially when the top line numbers don't scream disaster,
Yeah.
well, it usually points to something far more significant, maybe something painful lurking just beneath the surface.
Right.
It's often the silent killer for investor confidence.
Precisely. So in this deep dive, we're going to pull back the layers on LKQ Corporation's second quarter of 2025 earnings. We'll try and solve that paradox of, top-line stability against a major profitability shortfall.
hmm
We'll dissect a truly severe downward revision of their full-year financial guidance and understand why this company has shifted so rapidly from being seen as a steady, predictable earner to, well, a complex turnaround story.
Quite the shift.
Yeah, quite the shift. We've distilled all the essential insights from various earnings analyses and reports to provide you with a shortcut to being well-informed on this pivotal moment for LKQ. Okay, let's peel back these layers. So, the immediate market reaction was swift and, frankly, brutal. We saw LKQ's stock plunge by up to 15% right after the announcement.
Yeah,
Now, that kind of reaction usually signals catastrophe, right?
it certainly makes you think that.
But here's the puzzling part. The actual revenue numbers, when they came out, seemed, well, surprisingly okay.
Precisely. That's the first layer of the paradox, isn't it? Despite that steep drop, LKQ reported revenues of approximately $3.64 billion.
Okay.
And this figure largely met Wall Street's expectations, which had a pretty tight range, actually, from about $3.61 billion to $3.66 billion.
So pretty much on target.
Yeah, and it was only a modest 1.9% year-over-year decline from Q2 2024's $3.71 billion. So, on the surface, sales held up reasonably well.
So the market wasn't really fazed by sales being slightly down, but the stock tanked. That disconnect is the real riddle here. What does it tell us when a company hits its revenue targets but still sends investors running for the hills?
Well, it points directly to, like I said, a silent killer for any business. A severe margin squeeze.
Margins.
Exactly.
Right.
Revenue might have held the line, but below that surface, the cost of generating those sales, or maybe the inability to pass on costs, absolutely gutted profitability.
Gutted.
Yeah. The adjusted diluted earnings per share, or EPS, came in at $0.87. Now, that was notably short of the consensus estimate, which was around $92.94.
Okay, so there's a definite miss there.
A definite miss, and it represents an 11.2% decline from the 98 cents in adjusted diluted EPS they reported in the same period of 2024. This miss was really the first flashing red light that this was a profit problem, not just, a sales problem.
So the profitability miss was a clear warning sign, but it wasn't the final punch, was it? Was there something even more devastating in that earnings report? Something that didn't just rattle the stock, but fundamentally rewrote LKQ's entire future outlook?
Oh, there certainly was.
Yeah.
Most critically, the company issued a severe downward revision of its full-year financial guidance.
The guidance.
Yes, across key metrics, organic growth, EPS, and free cash flow. And this wasn't just a minor adjustment. It signaled that the challenges they were facing were expected to persist, maybe even deepen, affecting their outlook for the entire year. That's what truly spooked the market.
And what was management's initial explanation for this sudden downturn? Did they offer one?
They did.
Yeah.
Management largely attributed the challenges to persistent macroeconomic pressures, both in North America and Europe.
Okay.
They cited soft repairable claim volumes, which, directly impacts their core business, and just general economic uncertainty as key factors. Essentially, they pointed mostly to external forces.
So if we connect all these dots, this quarter wasn't just another earnings report. It feels like it fundamentally shifted how LKQ is perceived. What core themes are now defining this company's story moving forward?
Yeah, if we zoom out and look at the bigger picture, several crucial themes really jump out. First, as we've said, a clear profitability crisis. That's front and center. Second, there's this overarching transformation narrative that's now driving their strategy. Management is framing these current difficulties as sort of part of a necessary strategic overhaul.
Okay, a turnaround story.
Exactly. Third, the underperformance seems critically centered in their European segment. That's a real sore spot.
Right.
And finally, the company's robust cash flow generation and its commitment to capital return. Those are standing out as a crucial financial safety net in these turbulent times.
Okay, let's dig into that profitability issue a bit further then. When we dive deeper into the numbers, While total revenue was $3.64 billion, that modest 1.9% year-over-year decline, it was largely in line with analyst estimates, as you said. Even organic revenue for core parts and services, although it saw a 3.4% decline, the main problem wasn't demand, was it? It was definitely the profitability story.
Yes, the heart of the issue really is the margin squeeze.
Mhm.
As mentioned, adjusted diluted EPS came in at 0.77 cents, missing estimates by, what, 5 to 6%?
Yeah.
And down 11.2% from the prior year.
Yeah.
And to illustrate this further, adjusted EBITDA, that's earnings before interest, taxes, depreciation, and amortization,
Yep.
a key measure of operating profitability,
Right.
was $423 million. That fell 5.3% short of estimates, which were hovering around $446.5 million. These numbers just painted a really clear picture of profit pressure.
But hold on a second. This is where it gets, well, truly counterintuitive for a lot of listeners, I imagine. Despite this grim profit picture on the adjusted side, their GAAP diluted EPS generally accepted accounting principles that actually increased by 7.1% to 75 from 77 cents.
Yeah.
How do we make sense of that? It almost sounds like two different companies reporting.
That's a great question, and it's precisely why sophisticated investors and analysts overwhelmingly focus on the adjusted figures.
Okay.
See, GAAP EPS includes one-time events, or maybe non-recurring items, that can distort the view of underlying operational performance.
Got it.
Adjusted figures, on the other hand, they strip out those anomalies to provide a clearer, more repeatable view of how the core business is actually performing day to day.
Right.
So while the GAAP number might have looked better due to some specific accounting adjustments, maybe a one-time gain or something, the adjusted numbers, which reflect the true health of the ongoing business, told a very different story.
And that story was?
A pervasive margin compression. It means the company either had to spend more or accept lower prices just to achieve its sales targets. That's the core operational issue.
That distinction is absolutely crucial. And as we touched on earlier, while the Q2 miss itself was, disappointing, the full-year guidance cut was far more impactful than anything else.
Oh, definitely.
This wasn't a minor tweak. This was a fundamental reset. Signaling challenges were expected to persist, and that just deeply shook investor confidence.
It certainly was. And to quantify just how stark this reset was, let's look at the sheer amount of red ink across their guidance metrics.
Okay.
For organic revenue growth in parts and services, their outlook was slashed from a range of 0% to plus 2% growth, all the way down to a decline of 1.5% to 3.5%.
Wow, from growth to decline.
It's a profound shift.
Hmm.
Represents a staggering, 350% change at the midpoint, going from expected growth to expected contraction.
A 350% change. That's just monumental, a monumental reversal. And what about the profit outlook? Did that get hit as hard?
Pretty hard, too. Adjusted diluted EPS was reduced from a previous range of $3.40, $3.70, down to $3.30. That's a substantial $0.40 cut, or about 11.3% reduction right at the midpoint.
Ouch.
And their free cash flow, or FCF, that's the cash a company generates after paying for operations and investments, basically the money it has left over.
Right, the leftover cash.
That was cut from a range of $750 million, $900 million, down to $600 million, $750 million.
Still a lot of cash, but
it's a $150 million reduction at the midpoint, or about 18.2%. It signals significant pressure on their future cash generation capabilities.
So management cited a confluence of macroeconomic factors and the Q2 results as the reason for these cuts. Their CFO, Rick Galloway, even broke it down. 50% of the EPS cut blamed on North America, 40% on Europe, 10% on higher interest expenses. But here's what truly baffles me and probably a lot of our listeners. This guidance was given just 3 months ago, presumably with some degree of confidence.
I think so.
For it to implode so dramatically in one quarter. What does that really say about management's grasp on their own business or maybe the market they operate in?
It forces a very uncomfortable question for investors, doesn't it? Was the initial forecast just overly optimistic, wildly so? Or was there such a rapid, unforeseen deterioration in the market that management couldn't possibly have predicted it?
Right, either way.
Either way, it fundamentally erodes credibility. When a leadership team has to walk back such critical numbers so quickly, so dramatically, it transforms the company into what we call a show-me story.
A show-me story. Explain that.
It means the burden of proof is now squarely on management. They have to show the market, prove to investors that they can meet even these newly lowered targets. Because right now, their crystal ball is looking, let's just say, a bit cloudy. Trust has been damaged.
Okay. In response to this challenging quarter, LKQ's leadership, led by CEO Justin Jude, they didn't announce a brand new plan, did they? Instead, they framed the underperformance as a catalyst to accelerate the company's existing multi-year transformation plan.
That's right.
Jude acknowledged, "We are not where we need to be," which is quite direct. But then he immediately pivoted, saying, "So we are going to push harder and move faster."
This acceleration of transformation is really key to understanding their response.
Yeah.
The plan itself, which they laid out back at their September 2024 Investor Day, rests on four main pillars, each designed to tackle different aspects of their business.
Okay, what are those pillars?
First is to simplify business portfolio and operations, basically streamlining things, divesting non-core assets, prioritizing their core non-discretionary businesses. The stuff people need regardless of the economy.
Makes sense.
And this current crisis has only heightened the emphasis on strategic review for potential further asset sales. They're likely looking harder now.
And the other pillars of this accelerated strategy, what else are they pushing harder on?
Second is to expand lean operating model globally. This is all about scaling productivity improvements across all regions, getting more efficient everywhere.
Lean operations.
Third, invest and grow organically. So continuing investment in their core businesses, aiming for above-market growth even in tough times.
Okay.
And finally, pillar 4 is pursue disciplined capital allocation. This focuses on maximizing shareholder value, specifically looking at return on invested capital, or ROIC, making sure the money they spend generates good profits.
So with this accelerated pace, this pushing harder, what immediate tangible actions are they actually taking right now? What can we see happening?
Well, to really drive this transformation, they're targeting an additional $75 million in cost reductions.
Wow, another $75 million.
Yeah, primarily in Europe, but also some in North America. And importantly, this is on top of $125 million they've already cut in the past year.
So $200 million in total cuts recently. That's aggressive.
Very aggressive. It shows an almost desperate focus on cost control right now. They're also undertaking a significant leadership refresh. Over 25% of roles at the vice president level and above have changed.
A quarter of the VPs.
Yeah, and they've created a new executive position focused specifically on global talent development. It's a clear signal of trying to bring accountability and maybe some fresh perspectives into the mix.
This sounds like, well, a double-edged sword, though. Accelerating a major transformation is a gamble, isn't it?
Yep.
While it's intended to fix issues, management themselves acknowledge that some initiatives, like major system changes happening in Europe, might actually be contributing to operational disruptions and, quote, negative customer experiences. That creates heightened uncertainty. It almost feels like they're trying to fix the plane while it's still in flight and maybe hitting some turbulence caused by the repairs themselves.
That's a critical observation. It really highlights the inherent execution risk in any large-scale transformation.
Yeah.
When you're trying to fundamentally change how a massive global operation works, you inevitably introduce friction, potential short-term setbacks.
Right.
The challenge for LKQ is ensuring those disruptions don't become permanent wounds, especially when dealing with customer experience. That can be hard to recover from.
All right, let's zoom in then on the different segments because the overall numbers, as we know, can mask a lot about what's really happening underneath. Starting with wholesale North America, that's historically been a strong segment for LKQ, hasn't it?
It has. But this quarter, it reported revenue of $1.442 billion, which was down 2.2%. Not terrible on the top line, but the profitability story is stark.
Okay.
EBITDA fell to $227 million. That's down 11.3%. And the margin compressed significantly. By 150 basis points, it's 1.5 percentage points down to 15.8%.
Oof, 1.5 points is a lot.
It is. Now, the interesting dynamic here is that LKQ is actually outperforming the underlying market for repairable claims by an impressive 650 basis points.
Right, outperforming by 6.5%.
Yes, which indicates they're successfully gaining market share. That's the good news. However, this came at a steep price. They saw a 100 basis point decline in gross margins, likely due to competitive pricing needed to win that share.
So LKQ's North American business is actually gaining market share, which sounds great on one level, but you're saying it's coming at a significant cost to their profitability. Is that a sustainable strategy, or are they playing a dangerous game there?
Well, it's a classic strategic trade-off, isn't it? They're clearly prioritizing growth and market dominance, perhaps hoping to squeeze out weaker competitors over immediate profitability.
Okay.
And while it can secure a stronger long-term market position, it is a high-stakes gamble. The risk is, if the market doesn't recover quickly, Or if competitors can afford to sustain lower prices too, LKQ might find itself stuck in a protracted price war.
Which would just keep eroding profitability.
Yeah, exactly. Profitability even further, potentially weakening its financial position in the long run. So like, winning the battle, but potentially losing the war if they're not very careful in managing that balance.
Okay. And Europe. We heard earlier that's the epicenter of the crisis. What's the picture there?
Indeed. Europe is now LKQ's largest segment by revenue, and unfortunately, it's most troubled. Revenue is $1.61 billion, down 2.0%.
Yeah.
Similar top-line pressure to North America.
Profits.
But EBITDA,
It plummeted to $151 million. That's down 13.2%.
Hmm.
And its margin compressed 120 basis points, falling to just 9.4%. That's quite low for this kind of business. Wow, yeah.
and what's truly maybe astonishing here is management's crucial admission of self-inflicted wounds.
Right, you mentioned that.
CEO Justin Jude stated pretty clearly that operational changes they implemented had unintentionally created negative customer experiences, and that led directly to top-line erosion because of service issues.
So it wasn't just the economy.
No,
Yeah.
this isn't just about external economic headwinds over there. It's about internal missteps creating significant problems. That's a tougher fix.
That admission of self-inflicted wounds in Europe is frankly pretty stunning for a company of this scale. It really tells us this isn't just about the macro environment, it's about internal execution. So what's their immediate plan to, well, stop the bleeding in what's now their largest and most troubled segment?
Well, their direct responses include those leadership changes we discussed earlier. They're hoping fresh eyes can help.
Okay.
They've also announced a new strategic partnership with a company called Sphenetic Limited, focusing on developing their salvage channel. That's an important part of their parts supply chain in Europe.
Right.
And there's a big focus on SKU rationalization, which basically means optimizing their product offerings, maybe getting rid of less profitable or slow-moving parts, trying to simplify.
Makes sense.
But look, the success or failure of the entire LKQ turnaround really hinges disproportionately on whether they can fix Europe. It's become the biggest variable in their whole story right now.
Any good news at all coming from the segments? Was there anything positive?
There was a glimmer of hope, perhaps, from the specialty segment.
Okay, specialty.
Yeah, revenue there was basically flat year over year at $465 million. But management actually highlighted this as its best quarterly revenue performance since way back in Q4 2021.
Oh, interesting. So relative strength.
Relative strength, exactly. Now, EBITDA did slightly decline to $39 million, so profitability isn't perfect there either. But management expressed some cautious optimism that this segment might have turned a corner or possibly bottomed out.
So maybe stabilizing.
Maybe stabilizing. It's certainly not, out of the woods entirely, but it's definitely a more positive sign in an otherwise pretty challenging report.
And the self-service segment? It's smaller, but how did it fare?
Yeah, those smaller, self-service actually demonstrated a model of discipline, you could say. Revenue was $129 million, down 3.0%, so it saw some decline.
Okay.
But its EBITDA was flat year over year at $13 million. And they achieved this stability, despite lower revenue, by maintaining a solid 10% EBITDA margin.
How'd they manage that?
Through what they call disciplined vehicle procurement, meaning they're being really smart and selective about the salvage vehicles they buy to dismantle and just tight overhead cost controls. It kind of showcases solid operational management, even in a tough environment,
Right.
holding the line on costs.
So despite all these operational challenges, the margin pressures, the European issues, LKQ's financial foundation, its balance sheet, its cash flow generation, and its commitment to shareholder returns, that still remains a source of considerable strength, doesn't it? It almost feels like a financial bedrock holding things together.
It really is. And honestly, it's probably what prevents this challenging period from becoming a full-blown existential crisis for the company.
Right.
LKQ generated $296 million in cash flow from operations in Q2 and a really robust $243 million in free cash flow, or FCF.
That's strong cash flow.
Very strong. It clearly shows the inherently cash-generative nature of their underlying business model, even when profits are squeezed.
But even that strong FCF is under pressure now, right? Because of the guidance cut.
Yes, it is. That full-year FCF guidance was significantly cut, remember, down to the $600 million to $750 million range.
Okay.
This signaled an expected weakening in the second half of the year, likely due to those lower earnings projections and maybe some tariff headwinds they mentioned. So while the cash flow is still substantial, it indicates the pressure is being felt across the board, even impacting their cash-generating abilities going forward.
And their commitment to shareholder returns. We hear companies talk about that. But is LKQ still holding strong on that front as they navigate these choppy waters?
It seems so. It remains a key pillar of their investment thesis, and it offers that paid-to-wait element for patient investors.
The dividend and buybacks.
Exactly. In Q2, they returned $117 million to shareholders. That was composed of $39 million used for repurchasing 1.0 million shares and $78 million paid out in cash dividends.
Okay.
And importantly, the company also declared another quarterly cash dividend of 7.30 per share, maintaining the payout. Plus, they still retain $1.6 billion under their existing share repurchase authorization, which runs through October 2026.
So plenty of ammo left for buybacks if they choose.
Plenty of ammo. So even with all the challenges, they're signaling confidence in their long-term ability to continue rewarding shareholders. That's a positive signal.
So bottom line on the financials, their balance sheet is still solid enough to weather this storm? No immediate liquidity concerns.
Absolutely. The balance sheet remains solid. They have about $4.5 billion in total debt, but their total leverage, measured as debt to EBITDA, is around 2.6 times. That's generally considered manageable. And this provides critical financial flexibility. It allows them to fund this accelerated transformation, even with its risks, without facing an immediate liquidity crisis. It gives management the runway it needs to execute its plans.
Okay, so wrapping this up, LKQ Corporation is clearly at a critical juncture, no doubt about it. The Q2 results, and especially that guidance cut, have transformed it into what some analysts are now calling a battleground stock.
Good term for it.
Its core strengths, its market position, impressive scale, strong cash flow, they're currently being overshadowed by these severe near-term challenges. Deep margin compression, persistent macro headwinds, and, critically, those internal operational execution failures we talked about, especially in Europe.
Yeah, if we look at the optimistic scenario, right, transformation succeeds, bull case.
Yeah.
Well, it relies on a few key things happening.
Okay, what are they?
New European leadership has to fix those service issues and stop the customer erosion. They need effective implementation of that extra $75 million in cost cuts. North America needs to find a way to balance winning market share with actually maintaining profitability.
Right, that trade-off.
And they need continued strong free cash flow to keep funding those shareholder returns, if all that happens. Well, for patient investors, the significantly de-risked stock price could present a real value opportunity down the line.
But on the flip side, what about the more pessimistic view, the bear case, where the transformation falters?
Well, this transformation falters. Bear case sees Europe's turnaround just failing to gain traction. Maybe the transformation initiatives actually cause more disruption than they fix.
Ooh, that's a risk.
Yeah, maybe competitive pressures intensify further in North America, leading to deeper, more damaging price wars. You could see further guidance cuts becoming necessary. And ultimately, weakening FCF could jeopardize the buybacks or even the dividend.
Not a pretty picture.
No. In that scenario, the stock would likely remain stagnant or maybe even decline further. And that show me story we talked about just turns into a missed it story.
So what does this all mean for you, the listener, trying to make sense of this? What are the key catalysts and risks you should be monitoring in the coming quarters to see which path LKQ is actually taking?
Okay, number one, without a doubt, European performance. That is the single most important variable, as we've discussed. Any concrete sign of stabilized service levels, evidence they've halted customer erosion, and actual margin recovery in the Q3 and Q4 reports. That will be a major positive catalyst.
Europe first and foremost. What else?
You'll also want to watch the margin trajectory very closely, specifically the segment EBITDA margins for both North America and Europe. Are there clear signs of them bottoming out? Are they starting to improve, even slightly? That trend is key.
And what other specific details should we keep an eye on? Are there other milestones?
Definitely monitor their progress on delivering that $75 million in additional cost cutting. Management needs to show they can execute on those targets. Also, keep an eye out for strategic divestitures.
Selling off non-core parts.
Exactly. The sale of any non-core business unit would be a powerful catalyst. It would prove progress on that simplified pillar and potentially unlock capital they could reinvest or return to shareholders.
Okay.
And of course, you can't ignore the external factors. Keep watching the broader macroeconomic data, things like repairable claims, volumes trends in North America, and overall consumer confidence in Europe. Those will continue to shape the operating environment, regardless of LKQ's internal efforts.
It feels like the market has already priced in a lot of the pain for LKQ, given that 15% drop. The coming two quarters, Q3 and Q4, seem absolutely decisive. They'll really start to prove whether the company's current challenges are just a temporary storm they can navigate or if this represents a more permanent, damaging change in its corporate climate.
Absolutely critical period ahead.
So, a final thought for you, our listener. What stands out to you about how a company navigates such a pivotal, challenging moment? And if you were watching this unfold very closely, what specific sign, maybe just one key indicator, would you look for to know which way the wind was truly blowing for LKQ? Something to think about.